let's meet our panelists. To my immediate right, okay, beginning with James Catalano, okay, he's a partner at Citrin Cooperman. To James's right, okay, we have, where's Chris Mendez? He's down at the end there. Okay, I'm sorry, Chris. Chris is at Crowell Moring. We have Bruce Frumerman of Frumerman Nemeth, Ed Tedeschi of PB Investment Partners, Jack Seibald, okay, and Rob Ansell of Opus. Just raise your hand, please, there. Thank you. Okay, so let's start with the following. There we go. Ed, I'm going to come to you first. You've been in this business a long time, decades. You've had a hand in launching, I think it's approximately 2,000 plus or so financial entities, okay? So given your background, what items can you share with the audience right now? What things should they keep in mind? What are the top points that someone launching a fund should keep in mind?
Sure. As we go through the night here, we'll have more answers to specific questions. What I want to give the audience is observations that I have seen on a consistent basis over the years for somebody contemplating launching a fund or an RIA or what have you. So how many do you want, Bob? 3, 5 in that neighborhood?
Yeah, give me three or four.
Okay. So the first thing I would tell you is when you're launching your own fund or IRA, whatever the case may be, you're becoming a proprietor. Your name's on the door, you own the business. You're coming from an environment where everything's done for you. You just got to show up, raise your assets, trade your portfolio, do your research, what have you. Most people don't understand the concept of they are now a business owner. Very, very detrimental. So accept that up front and also accept the fact that, and admit, know what you don't know. I have seen way too many firms crash and burn, not even getting out of the gate. Okay, so that's number one. Number two, take the time and really outline a business plan. Have a whiteboard session that you do multiple times. One is you'll get a clearer vision of what you want to do, time horizon to accomplish that, and you will also need to determine what type of operating capital you need to put up to survive. Very, very important. So for those of you that have seen The Dirty Dozen, you know how they train and they're constantly training before they storm the chalet, but as they're approaching the chalet to storm it, they're going over the plan. That would be very, very helpful to you. Too many people underestimate the level of sophistication, complexity in some cases, and planning that's required. 3, you have to be able to articulate your message, whatever your secret sauce is, to your potential investors. If you fall on the sword, that investor is gone. So know what you're good at. You want to make sure you're in the short pile that you're in for consideration and will keep you on the radar versus the pile of everybody dismissed. Too many managers cannot articulate their message. You need to be able to articulate it. 4th, when it comes to what you think your launch AUM is going to be, okay, have a good realistic estimate and then cut it by at least 50% because you're going to launch with a lot less than you think. So that's helping you manage your expectations. And 5th, and probably equally important, you're there to generate the returns, the ideas. You don't necessarily know how to run the firm. Don't meddle. You're going to hire a COO or a CFO or somebody with experience and knowledge. Let them do the job. Don't micromanage and get involved in things you know nothing about. If you take those 5 things, you're going to be off to a very good start.
Eddie, thank you. And before we go any further, maybe it would be good if each member of the panel, and we'll begin at the end of the table, Chris, with you, give the audience a little bit of background on yourself, okay? On the firm and your particular interest in startup, small and emerging managers. Chris Mendez, please, why don't you start?
Yeah, of course. Chris Mendez. I'm a alternative investments lawyer here in New York at Crowell Moring. We're a 700-person or so law firm, DC headquartered. And I'm in the financial services group, and I represent asset managers, generally asset class agnostic, but a lot of what I do is representing hedge funds, both new and emerging managers, so first-time fund managers all the way through fund 2, 3, 4, large institutional investors. and allocators. And prior to that, I was a general counsel twice at two different asset management firms, both that started essentially Fund 1. So I was a general counsel CCO at two firms that started very much Fund 1 emerging manager, and both grew into multi-billion-dollar firms. And then before that, I was in the financial services group at Goodwin Procter, also here in New York.
Chris, thank you. Jack Seibald of Marex.
Yeah, hi, I'm Jack Seibald from Marex. I run the prime brokerage and outsourced trading business globally with my partner. We were formerly the Cowen prime brokerage business that spun out after TD's acquisition of Cowen. We've been at it for, the better part of 25 years. Our focus is predominantly on emerging managers, though through growth and success. Our stable of clients now consists of many multi-billion-dollar funds as well. It's nice to see managers grow who are partners with you throughout their stages and retain part of that business with you over time. Prior to getting involved in the prime brokerage business, I grew up on the investment side. I was a sell-side analyst back in the 80s, and then ran a hedge fund some 30 years ago. So the perspective we bring to our clients, our prospective clients, is that we actually sat in your seat. We knew what it was like to raise money, to draft a plan, and all of the things that Eddie mentioned. They're critical. And a lot of the services that we provide are meant to assist in that process before a fund launches.
You know, and I just want to say that I met Jack about 25 or 30 years ago when he was running a hedge fund, and he was affiliated with a broker-dealer, which eventually became the basis of Marex, Cowen, et cetera, et cetera. And I just want to say, I think it's very interesting and impressive to see how they've evolved over the last 30 years into a self-clearing, a real prime broker, a fully credentialed prime broker. But very nice to have both of you on. Bruce Frumerman, how about you? Tell us about yourself.
Hi, my company is Frumerman Nemeth, Inc. We are a 37-year-old financial communications and sales marketing consulting firm. Our work has helped money management firm clients attract over $7 billion in new assets, yet we are not third-party marketers. People hire us to tell them what to say, how to say it, how to put it in written and verbal form, to make it through a 2 months to 2 year selling cycle with sophisticated investors, and how you get third-party endorsement for the intellectual acumen of management, because that's really the main thing that everybody has to sell. Our clients range from one-man pre-launch with 0 AUM to multi-billion AUM-sized firms. There is so much that has to be covered by everybody here today. And Ed, as you were talking with the point that you were making earlier about, and you have to understand there's a business. I was speaking earlier today with a family office investor, and I told about the main event, and I said what the topic was. And he said, you know what always pisses me off about these events? There's never enough explanation, and because they're missing 3 words, and raise capital. What are the things that you have to do that dramatically affect your ability to raise capital and stay in business? So when you mentioned about you're actually running a business and you're now a business owner, we all know and see, if you don't show you have a small business owner's head on your shoulders in addition to a good strategy, you're not getting anywhere. And everybody on the panel is going to weave to that.
Yes.
Last point, since there's so much to cover. If you are a money manager in this audience, there are 2 marketing plans you need to have, not just one. Take your business card, write 2 plans on the back of it, and hand it to me. I'll send you that information later.
Okay. Bruce, thank you. Rob Ansell.
Hi, Robert Ansell with Opus Fund Services. Opus is an award-winning fund administrator. I guess our sweet spot is probably like the $25 to $500 million launches. I think, like similar to Marex, in the regard that we used to have lots of, and a very strong reputation for emerging managers, but now we have many multi-billion dollar managers who started with us when they were 10, 50, 100, and now they've grown and stuck with us. But what we haven't done is forgotten our roots and forgotten our origins, which is why we're here tonight, because we still have huge expertise on helping emerging managers. But my background, so I've was at Opus. I've lived in the States for 14 years. I was in Hong Kong before that, London before that. But interestingly, I've worked on the sell side with Barings and Macquarie. Then I worked at a fund. And then I moved from the fund directly to Opus. And at the time, Opus was my administrator when we were at the fund. And so I got to know Opus, truly got to know them from the inside, from the outside. And that became an easy decision to go and work for them. So I've got that perspective from being from both sides of the line.
Rob Ansell, thank you very much. James Catalano.
Hi, everybody. James Catalano. I'm an audit partner with Citrin Cooperman. We are a full-service accounting firm. Today, the top 100 accounting firm list came out. We're up at number 17 now, so we continue to grow. You may have seen us in the news recently. We were recently acquired by Blackstone, so we now have Blackstone backing us. As I said, we're full-service accounting, audit, tax, advisory, outsourced accounting. We can do it all for you. Our sweet spot, mid-market clients, but similar to some of the others here, we work with some billion-dollar, multi-billion-dollar clients, as well as emerging managers. So we really run the whole gamut. And similar to Rob, some of the perspective that I can give is I can see both sides of it as well. Prior to getting into public accounting, I did work as a controller, assistant controller for a broker-dealer in the real estate industry. So I know some of that operational challenge that you do have sometimes.
James, thank you very much. And before we go forward, I do want to call the audience's attention to the fact that we have two friends in the audience. We have John Clancy of Murray Asset Global Securities. John's also in the prime brokerage business, supporting startups and small managers. And Glenn Carballo of Dime Bank back there. And obviously, you can't do anything in this business unless you open up a bank account. So if you have questions about that, by all means, please talk to Glenn back there. So Chris, I want to come to you first, all right? What are the key legal and tax considerations that a launch needs to consider?
Sure. So I generally, when I'm speaking to first-time fund managers, I try to categorize those considerations into 3 buckets. Right down the middle is the fund, of course, setting up the fund. So much of that is driven by, or at least the domicile or jurisdiction of choice is driven by the LPs or the investors. And that is typically driven by tax, right? So right down the middle, setting up your fund, the biggest legal consideration or tax consideration is where are your investors? What are the tax considerations for those investors? Ideally, what you're trying to do is maximize after-tax returns. In the US, generally, most managers typically set up, if they're managing capital for US-based non-tax exempt investors, they typically set up in Delaware because they're generally not tax sensitive. Oftentimes, as managers scale, they tend to take on tax exempt or tax sensitive managers, and that's when you start to see offshore jurisdictions utilized. Oftentimes Cayman, BVI are often jurisdictions of choice. Much of that is for tax planning purposes. So right down the middle, legal tax considerations is the fund. Then to the left and to the right is going to be the management company, the principals, the sponsor entities. So your management company that you're setting up, the general partner entities that you're setting up, and much of the legal and tax consideration there, one is the formalities around forming your business, the corporate entities themselves, the relationships amongst the principals. If you're spinning out with 2 or 3 principals, ensuring that you're properly documenting the relationship amongst the principals. Oftentimes I'm working with the Citrin Coopermans of the world to try to do the same thing we're doing for the underlying fund investors for the principals, setting them up to ensure that the revenue and the management fees and the carried interest that they're receiving from these funds are also structured in a very tax efficient manner. So right down the middle, the fund, to the left and right, the business itself, engaging service providers, vendors, hiring, that sort of thing. And then to the right, legal, less tax, legal is the regulatory component. So are you registering at the state level as an SEC register or as a state level registered investment advisor, or are you registering at the SEC level? Generally, that's an AUM threshold around $100 million or above. You're registering with the SEC. And then there are some other regulatory components of that, hiring a COO and having a regulatory compliance program in place. But generally speaking, for new and emerging managers, hedge funds, you're going to focus on those three buckets. And then there are, of course, obviously other more manager GP specific considerations under each of those buckets.
Okay, and Eddie, I think you might have a comment or two on that topic, the
In
legal
re-
documents.
You know, the legal documents is determined by what your strategy is going to be, as it was outlined. You know, it's the longest part of your startup environment. You need to go through it many, many times. There'll be many iterations of it. And, you know, you rely on your lawyers to provide you with the best advice possible, but you also have to provide the questions as well, because every manager has idiosyncrasies, and you need to factor in your idiosyncrasies at the beginning.
Yeah, it's a common, just reiterating a point you made earlier about a common theme of spinning out of a bigger manager where you have a front, middle, back office supporting you, and your job is really to just focus on returns. A very common theme that I'm navigating with first-time fund managers, they've never had to negotiate a partnership agreement, they've never had to think about a PPM offering documents, they've never had to have tough conversations with their business partner about how we're splitting management fees or carry. They haven't had to hire an accounting firm to help them prepare K-1s and that sort of thing. So it's very different situation, and when you're trying to put up returns, it's also very stressful, right? It's a lot, it's overwhelming.
So, Chris, just to pick up on, I think the flow of your statement. So, how should managers approach negotiating fees, liquidity terms, and so on and so forth? What advice would you give them?
Yeah, well, you generally, at least in that 1 to 3 year period, the common advice that you're often going to get is you want to at least personally have a few years of runway so that you can keep yourself sustainable while you can actually raise and put up decent returns, so you can actually start to scale up and talk to bigger allocators. In order to do that, you need to be very thoughtful and cost efficient with your business. And the way that you do that is by targeting the right service providers who are catering to your specific size and asset class. So from my perspective, on the legal side, that's often how I'm pitching a lot of the new and emerging managers. That's how I'm differentiating myself. You can go to a larger law firm and you can spend $500,000 $500,000 to $1 million setting up your fund and setting up your manco. Where I'm trying to come in and be a bit more cost effective, I'm coming in and saying, well, we could do that, a fourth or even
Sure.
less. Or oftentimes, what I'm seeing a lot of law firms doing, if you're really pedigree manager and they do believe in the success and you do have a sizable LP base, they're willing to float the legal costs, because oftentimes those are organizational expenses, and they know that that's going to be paid by the underlying pool. So they'll help you. I see that happen often. They'll lawyers will set up your management company, your GP, set up the fund while you're out raising capital, and then when you actually have your first close, that's when you can actually pay the legal fees. But generally speaking, just like any other service provider, just like any other thing when you're shopping, you're trying to find the most cost effective. And when you're new and emerging manager, don't have a lot of fee income, you haven't yet received performance allocation, you're trying to be very thoughtful about that. It's a common mistake. I mean, it's often, I will get managers who we've ported over from big firms that are used to working with Blackstones of the world, where costs are often not as big of a consideration. And they might go to a big firm because they want a big name in their PPM. They think that's a meaningful name to have in the PPM. And oftentimes they're just not getting the same level of attention that they would at a big law firm. And mainly because from the law firm's perspective, the economics, they look at it and they say, overall, over the course of 1, 3, 5 years, how much revenue am I going to generate from this
Sure.
client? They're not going to spend a lot of time with a new and emerging manager.
I'm just going to make a statement, then I'm going to pivot to the accountant here and ask the question about tax considerations from the standpoint of a CPA. But just as a general comment, and I ask the panelists to think about this, for the audience, for those who are thinking about actually launching a hedge fund, we talk about reputational value of vendors and professionals, right? I think one thing that we should address at some point is which vendors and professionals are more important on the nameplate, so to speak, than others, right? I think that's something we should probably talk about in a moment. But I want to talk to James Catalano right now about tax.
Yes, sir.
Okay.
So,
Tell us.
Chris, you hit a lot of what I had in my notes here, where what you need to start out thinking is, it's not just your fund, it's your firm as well. It's your management company, it's your general partner entity. And you want to think about a couple of things when you're looking at your organization, at your management company and general partner. You want to think about where you're located. If you're in New York City, probably want to make sure you've got two separate entities so you don't trip up any unwanted, unincorporated business tax issues. Your incentive fee, talking about incentive fee. You want to think about how that's going to be structured. Is it a fee? Is it an allocation? Some of that may be dependent upon what you're going to invest in and what your hold period is going to look like. Last point I want to make on taxes at the firm level is if you're in a high tax state, New York, New Jersey, California, you want to think about the corporate structure you use. In those states, you're limited with your state and local tax deductions, but there is a tool that allows you to take advantage of enhanced deductions, increased deductions, the PTEC, the pass-through entity taxation. That's a tax that's paid by the actual entity on your behalf, and you're allowed to then take it as a deduction. And in order to get that deduction and take that PTEC, you need to be a partnership with more than one owner in the entity. So these are the types of things you want to think about at the firm level, I'll call it. Then when you get to the fund level, as Chris mentioned, you think about domicile, and it's all based on where your investors are going to be located. So the big ones are Cayman, BVI for tax purposes, maybe Bermuda, you'll see Ireland once in a while, Jersey. But you want to think about that if you're going to have foreign investors and tax-exempt investors. The other thing to think about at the fund level is think about what you're going to trade, where you're going to trade. You may incur foreign tax liabilities if you're trading, say, equities in Spain. And that would be a liability of the fund, even though the fund is a pass-through entity. So you want to think about how you're going to trade and get the exposure that you want. I've had experiences in the past where to cut down on millions of dollars of tax expense related to Spain, had a client that decided to just start trading on swap in the US to get exposure that they wanted in Spain. You're not taxed on that in Spain. And once you start getting into the foreign tax requirements, there could be severe penalties if you miss filing. So something that you definitely want to talk to your tax service provider about. And just to make one other point, I'm an audit partner, but everybody wants to know about tax. This is the important thing when you're starting. It's very important that you've got an accounting firm that's going to bring audit and tax to you, and that the audit and tax team talks to each other and knows enough to say, hey, wait a second, that's an important tax concept. Let me get the tax partner to talk to you. So just something else to keep in mind.
Okay. James, thank you very much.
Sure.
I want to turn to Rob Ansell now. Rob, what does a fund administrator do exactly, and why is it important?
So, with regards to what does a fund admin do, it's amazing how people are told you need a fund admin, but then they don't actually realise.
I always wonder what you do.
Okay, but what's interesting is when you take
I know it's important.
It's important, but when you take a call from a new manager, the calls always has the same pattern. They'll start off talking about themselves and their background, which is always fascinating because there's such an amazing, diverse background of experiences and where they came from and why they're at the stage now of launching a fund. So you go through that, then they talk about the fund and what they're looking to do. And then you can sense that they've been told they need to have an admin, and that's why you're having the conversation. So then I'll always say, do you want a high-level overview of what a fund admin does? And 90% of them say, yes, please. So you just know that they have been told they need an admin, but without really understanding it. So assuming that there's some managers in the room, I'll just line out what does an admin do. And there's generally five tasks. So the first, let's call it investor services. So that's like getting the investor into the fund and then looking after the investor. So subscriptions, redemptions, transfers, doing the AML, the KYC of the investor, doing investor statements, updating the investor register, dealing with distributions, capital calls, and also when they exit the fund and redemption. So just think about everything to do with getting the investor in, processing them, keeping them in, and then helping them get out. So that's just one task. The second, let's call it accounting services. So, doing the NAV. Anyone that runs a fund, obviously the NAV is a key part of that process, and that's what the administrator does. So maintaining the general ledger, producing the management fees, performance fees, and then distributing the NAV, which involves the balance sheet, income statement, and most importantly, like the allocations report, which the manager reviews, approves, and then you release the investor statements. Third would be treasury. Some people call it treasury, some call it cash management. So this is, again, where the administrator basically has that independence over the fund has the independence over the bank account of the fund. So, there's never a situation where the fund manager can just wire money in and out of the fund without the administrator controlling that. So if you think about, Bernie Madoff, that was one extreme where that's what happens when there's no one over, looking at the fund and reconciling the bank account every day. So nowadays, that's what the administrator does. And in some cases, the administrator has complete control of the fund, which literally means that the manager, if he wants to wire some money out, he'll request a wire, and then the administrator will review it, approve it, and release it. And then there's other times where there'll be dual control. So that's the treasury function. Then the fourth is middle and back office. So the administrator will do cash recs, trade recs, position recs, trade capture, maintaining dividend accruals, etc. So there's that whole middle and back office function. And then lastly, I guess let's call it other services, which could be offshore, Cayman or FATCA reporting, doing the financial statements prep. So you list all these tasks, and then kind of the penny drops with the manager that you're speaking to. It's like, wow, that's a lot. They probably think, wow, how much is that going to cost me? And then they realize, okay, I've got to take this seriously. I thought this conversation was just going through the motions, but actually, there's going to be a lot of engagement with the administrator. And it's true, it's the administrator is an absolute key part of the fund on an ongoing basis, which means you've got to get the decision right. You've got to pick the right guy. Because if you don't, it'll be painful. So how do you do that? What advice would you give as to, how do I choose my administrator? So the thing not to do is to be attracted to shiny objects. Because that's one of our, as humans, we like shiny objects. I like a low price, or a nice website, or I like a nice name, or I know that name. No, that's not the way to go. So in my experience, having been on both sides, you need a combination of the following. You do need to factor in price. Obviously, price is important, but you don't have to go for the lowest cost all the time. So price, technology is key, and with technology, there's a difference between the front end and the back end. So on the one hand, every manager is going to be shown the front end, and some are going to be better than others. Some are going to look good. Some are going to just catch your eye, which is on the one hand important because the manager gets a portal, the investors get a portal. So that front end is important. It's the face of the fund. But the back end is also important because you don't want to pull back the curtain and then find there's everything's on spreadsheets, or it's all being done by humans, or it's all being done offshore, because that's not good. And that's not sustainable, and that will lead to problems. So you need to make sure that it's not just the front-end technology, but it's also what's going on behind the scenes. And you need to challenge your admin. When you're speaking to them, you need to say to them, can you show me what are your processes? What's your tech stack? What systems do you use? How are they integrated? That's key because you need that. You need them not to be paddling furiously below the surface to keep things alive. You want very high levels of automation. So we've got price, we've got technology, and then lastly, service. Now, service, unfortunately, is not tangible. I can't demo service. I can't show you service. But you need service, and especially for an emerging manager, you're going to need a lot of hand-holding to begin with. So everyone underestimates service. So the way that you can discern it is ask questions like, who's here in the States, who's on the ground, who's in my time zone, how am I going to be serviced, do I have a dedicated team? So you need to ask those questions. You can't just assume that because the person you're speaking to is in New York, that everyone else is in New York or everyone else is in your time zone. So you do need to understand how you're going to be serviced, what's the service model, where are people physically. And then ask around, get referrals, because people kind of know, where the bodies are buried. So, don't be afraid to ask for referrals, ask for references. But you need to understand about price, technology, and service, and you need a healthy combination of them all.
And Rob, if I can just add to that, you mentioned Madoff, right? Now, of course, Madoff was not a hedge fund, but he was a vertically integrated financial services company, right?
Right.
And so he was able to control all of these pain points that we're talking about, which made it easier for him to manipulate the outcomes, right? So isn't one of the things you're doing, in addition to providing the core competencies, it's independence?
It's absolutely independent.
And that's critical, because way back in the day, not all hedge funds had fund administrators. Okay, so this is actually not only a best business practice, it really is a necessary business practice.
Well, no one's going to give you money if they don't.
Today.
Yeah, today. If you don't have a fund administrator, someone, why would an investor give you money? Because
Correct.
it's
Exactly.
it could be going into a black hole. Yeah.
So Jack, let me come back to you. You have both sell side and buy side experience. Okay. So what are the key things you think people in the audience who are thinking about launching a hedge fund should be thinking about right now, considering?
Well, I think first and foremost, you need to know what you want to do. You need to know what your strategy is going to be. You need to know what your process is going to be, and you're going to have to be able to articulate it, to yourself, but also to others. It's going to be very important to know what the environment's like. Who else is doing what you're doing? If you're launching a healthcare fund, what's going to be different about yours? What are others doing in the healthcare space? You're going to need to do research and understand what the range of offerings are out there. Whether they're specializing in subsectors, whether they're doing more general, healthcare, whatever sector you're working on, you need to understand what you're going to be competing against when you go out into the marketplace, looking to raise money. And then you need to also, I think, really think long and hard about who your target investors are going to be. If you're a startup, oftentimes, you're going to be somewhat limited, in terms of the potential audience that you're going to be able to cater to. And one of the sayings we have, at our firm, and have had it all along, is just get started.
Yeah.
Even if it's friends and family, get started and start putting up, a track record. And then, work with, firms that have the ability to guide you through the process of identifying, the types of investors who are going to be interested in taking a look at your product. There's a very significant differentiation between, certain family offices that are, early investors, that might be seeders, at an institution, a big institution, who won't look at you, unless you have a 3-year record and you're running $100 million. So there's no point in wasting any time, with those types of investors at the early stage. Remember, you only get one opportunity to make a first impression, and you don't want to go waste that opportunity with investors who are not interested at that time, don't invest in startups, whatever it is. Quantity in this instance is not better than quality. You really need to spend the time to narrow the focus so you can talk to potential investors who are actually interested in what you're doing. And firms that have capital introduction teams or third-party marketers are able to help you in that regard.
And Jack, before you can be great as a money manager, you have to be able to break even, right? And in order to break even, you have to have the ability to carry the enterprise,
Of course.
okay? Can you speak to that for a moment? What kind of reserves should the manager consider having as they launch the business?
Well, look, I mean, I think it's very different for different startups. We see startups that literally are just putting up their own money or friends and family, and it's 10, $20 million. That's very different than somebody spinning out from one of the big platforms and starting with $250 million.
Right.
Right. The math is just very different. So for the former, the smaller ones, it's very important to understand that for the first several years, several meaning give or take 3 years, you're not going to make any money. You're going to essentially be carrying the business. The management fees just aren't enough off of those, that level of assets, to cover all of your expenses. So you're going to need to go into your pocket a little bit and be comfortable doing that for a number of years. One way to mitigate that, I think, my lawyer friend here has talked about fees, is look at the opportunities out there for firms who are willing to engage with you at cost levels that are materially less than others. Not saying, go downstream in terms of quality. Obviously it's important that, the capabilities of the firm that you're going to engage match your, match your needs. Not just today, but match your anticipated needs. But also be cognizant of the fact that, with that, there's a cost. And whether it's the law firm or the audit firm or the admin firm or the outsourced, CFO or whatever, or the prime broker, right? Some large firms won't really cater to startups, below a certain level of AUM just because they can't dedicate the resources. So, be cognizant of that and look for firms that, to whom startups are part of the strategy. Because you'll find that you'll be able to get things done for you that you wouldn't be able to get elsewhere.
Good enough. Good enough. Bruce, what should the portfolio manager do even before speaking to the lawyer?
Good question. As you were giving some of the explanation of where you guys give counsel, if somebody was making an LP, and Jack made reference to that too, if you don't start by figuring out what are the characteristics of the strategy that I'm running, to Jack's recent point of, and what's the target audience for that, this has implications for what kind of a thing you want to do. Because sometimes the strategy is more appropriate to start out to build a record by having SMA rather than going LP. Now all of a sudden it's a different set of questions and things that accounting has to counsel you on. It's a different set of things that legal has to counsel you on. But they need to know that your goal is, I want to get to the point of building, whether it's the friends and family or retail money, enough of a record to, when I grow up, move from SMA to LP. If you just walk in the door and go, hi, I want an LP, a lot of attorneys will go, okay. But the really good ones will go, now tell me, why is it that you're using that vehicle and what is it that you have? So it's worth figuring that out in advance. Second important thing, when it's time to make the OM, there's a whole bunch of stuff that has to do with fee structure and all that, and legal could help with that. But at some point, your attorney turns to you and says, okay, Ed, I'm now at the part to explain the methodology. What do you have to give me? And too many money managers go, oh, well, what else do you have in a template of somebody that's done something like me? And if you look at the lawyer's doing this. So you could get that part very wrong. Frumerman and Nemeth had a client a number of years ago. They sold to friends and family. They started to go after family offices. And nobody would give them the time of day. They couldn't figure out why. They came to us and said, it didn't occur to us till now. I could have been talking Jabberwocky and I still would have got the money I got. When we're going to strangers who are picky, it's something different. Help us figure out how to explain our methodology because we're doing something wrong. What we got out of their heads and onto paper was completely different from what they were doing. It now goes to legal, and legal's looking at it for compliance, and legal said, shit, this is what you actually do? We have to change your OM because what you told me before actually painted you into a corner here, and if somebody gets ornery, they could sue you. It's worth going to all of your existing customer base and say, I'm updating the OM, but it's to your advantage because we're giving more detail and more transparency. They had to spend an extra $60,000 to go get a new thing because it didn't occur to them. So those are examples of where there's a tie-in to accounting, legal. They can't decide that for you. You have to figure that out yourself or get people who have the skill set and experience to help tell you, no, don't take the road to the left, take the one to the right.
Okay, and Bruce, are there any strategic decisions that the managers need to make before they start raising capital?
Well, the biggest is relating to what you heard Jack mention when he said, and you have to have a message and you have to be able to explain it well. That part, when people hear that, they think, oh, okay, and then they figure they could just wing it. That's what screws up most companies. So as prime brokerage knows, as accounting knows, as fund admin knows, as legal knows, you end up getting this many emerging manager startups. The attrition rate is very high, and it's not because they had a trade that blew them up. It's because they were unable to convince enough people to understand and buy into how they invest. So if you don't get that part right before you even go to legal, you can't answer the OM question when he says, and how do we explain this part of the strategy? You also can't make your way through a selling cycle with somebody because it's not enough to say, hey, Ed, Jack said we should talk, and you talk to him and you think you had a good verbal conversation. That's not enough either. And of course, what you end up hearing is, well, you could hire a third-party marketer, but there's a problem. If you're little, you're like of little use to good third-party marketers. They need you to have a 5-year track record, have 500 mil under management, be in top quartile or quintile. Bob's your uncle, we could do stuff for you. If you're little and you don't have a track record yet, what do you think they're gonna do? And you don't want to get caught in the loop of I'm only selling performance.
Okay. Good, very good.
Can I add a point? Can I?
Yeah, please. In fact, I was just gonna say, we're about to wrap up on the launch. Does anyone want to add before we move on to capital raising?
Yeah, just because this is a common theme or a common point of discussion, particularly for first-time fund managers, I will spend a lot of time before we do any document drafting. Measure 20 times, cut once. I ask a lot of questions. I will take a first-time fund manager through a term sheet effectively, what will then become the PPM. And we'll walk through every single thing. I can't tell you how many times the PPM is drafted and then one of the principals says, oh, by the way, I think we want to start trading futures. Well, now I've got to go back and rework the documents to then add the CFTC NFA language. So before we do any drafting, the partnership agreement, the PPM, I take effectively replicate a term sheet from another hedge fund, and we walk through every single section. Did you talk to the auditors? Did you talk to the accountants? Did you talk to fund admin? I always advocate, let us get on with them. And we'll walk through processing NAV so the principals know how that's actually gonna work and what it actually says in the document. We'll get on with the fund accountants, with the auditors, because what happens when you close your fund in January or February, well, January or February the next year, now your LPs are chasing for K1s, right? And so you want to make sure that you're teed up for that. So before we do any document drafting, this is a great way to save a ton of money. What's great about the non-lawyers, your fund accountants, your auditors, your admin, the PB teams, many of them are just as smart as lawyers, and they're not charging you by the hour. So you can get on the phone with them, you can ask a million questions. Ideally, you do all the questions before you sign an engagement letter because they're willing to talk to you, they want to earn the business. Tell me how many funds you launch, what asset classes do you specialize in, walk me through your NAV processing, tell me about the audit partner who's going to be on my engagement. Do they know long, short, equity, healthcare focused hedge funds, right? So a lot of that you want to do on the upfront. And a lot of times managers, you could do that, start doing that a year before you're ready to launch, right? If you're launching with 20 or 30 and you're going to be effectively keeping yourself afloat, you can do a lot of that work before you cut off the lights at your prior shop and start anew. If you're launching with $250 million, probably not as much of a concern, but still, the management fee revenue you're generating off of $250,000 is barely enough to keep the lights on. You may be breaking even, regardless of the service providers you pick.
Okay, that's a very interesting opinion. And I would also, Jack, I don't know if you have a comment, and Eddie, you might as well.
Yeah.
But I know, Jack, you've done a fair amount of thought leadership on this topic.
Yeah, look, I mean, I think, you know, knowing what you're going to be doing is very important, and articulating that to every one of the service providers you're going to be talking to. I can't tell you how many times we onboard a new manager, and it's, all I'm going to trade is U.S. stocks. I'm not going to do anything else, just U.S. stocks. And the first trade they give you is you know, an Amsterdam-based stock. It's like, you know, you can't do that. You break the system, and it says a lot about the manager if they don't know that ahead of time. So it's, you know, really take the time, articulate to yourself how you're going to run this, you know, this fund or this pool of money, and articulate that once you're comfortable to every one of your service providers, so you can get the best advice from each of them.
Okay.
Yeah, I'd just like to add one thing. As you're starting up your fund, make sure that you're speaking with a bank, because before you can trade or even start to move the process forward, you need to have a place to put your startup money and the money that eventually go to your prime, and make sure that your bank is able to work with the service providers that you're kind of courting as you begin the process.
Colleen Carvalho of Dime, thank you. Ed Tedeschi, I think you had a comment or two to make.
Yeah, I just want to dovetail all the very comprehensive comments my colleagues made here. One is, the second point I made to everybody was, do the whiteboard. You just heard what the whiteboard exercise is from everybody on this panel. So make sure you do it, number one. Two, from a service provider perspective, they are invaluable to your fund, okay? And I'll give you a parallel. When my kids were going to college, one of the comments we had was, there's a college for everybody, right? Well, in the service partner community, I refer to my service providers as partners, because I can't do what I do without them. So they're my partners. There's a service provider for everyone. Do your due diligence and don't conduct a bake-off. I have spoken to so many guys that have called me and said, I'm speaking to 6 primes, and I'm speaking to 6 admins, and I'm speaking to 6 bankers. You know what that's telling me? You don't know what you're doing. In addition to that, you're pissing off the community that you need the support from. So don't do that. When it comes to service provider selection as part of your whiteboard, identify 3 that you think are a good fit for you, and use the following criteria, and will be very successful. 1, service and relationship. If you don't have that, don't go to number 2 and 3. You don't want to be with a firm that if you have a slightest issue, I have to call legal, I gotta call credit, I gotta call my mother. It's a disaster, and you can't run your business. It happens all the time. Bigger is not better. You do not need name brands to raise money. That is the biggest misconception in the world. You do not need Goldman or Morgan to raise money, okay?
Not that that hurts.
Yeah, but you know what? It's all relative now. This is a commoditized business. So if you have service and a relationship, the second criteria is technology and reporting. Does that permit me, does that augment my job where I don't have to buy software and snap things on and hire additional people? If you have 1 and 2, then it's economics. You're not a good partner to your partner if you think they're gonna lose money on you. But what your partner needs to look at and determine, are you a fund that's gonna grow, and they have to make the business decision, do they wanna take you as a client? It's a 2-way street, it's not a 1-way street. If you use those guidelines, you'll get to where you need to be, and you'll save yourself a lot of heartache. My audits And my K1s are out the door tomorrow. And why? Because my accounting firm and my fund administrator work very well together, but it's the responsibility of the COO or the CFO to make that happen. Don't blame your service providers for things your firm should be doing. Okay? You want a good relationship. Too many CFOs and CFOs, one, aren't qualified to be in that position, and two, they deflect and blame their service providers. It's a terrible thing to do, and you're gonna have a bad relationship.
Let's turn now to fundraising. Okay. Bruce, I've heard you say this over the years. You've said starting off asset raising by making a pitch book is the wrong thing to do. Then what is the right thing to do?
I've been leading teaching sessions for money managers at industry conferences for years. In the audience will be family office and foundation and endowment people and money managers. Every time that's happened, I took a pause in whatever the topic was and I asked for a show of hands. I wanted to know, when you end up looking at the first thing you get from the manager, which is the tear sheet or the flip chart, how much time do you actually spend looking at it before making the decision as to whether you take a phone call or a meeting? How long do you think the answer is? Anybody?
30 seconds.
90 seconds. Here's how it goes. It's objective, it's binary yes, no. Your performance and risk characteristics are within the ballpark of acceptance for us or not? Yes, no. Your AUM size and track record length meets our investment policy statement guidelines or it doesn't. You have generally acceptable back office service providers, or it's your cousin Lucy on Long Island who's been doing all of your bookkeeping and you don't really have an accountant. No thanks. If you've made it through all of that and they let you in the door, what do you think they actually want to know from you? It's not the numbers. They've already looked at the numbers, and that's assuming you've had it. Here we're talking about a startup, pre-launch, you don't have any frigging numbers. But even if you're 3 years old, 5 years old, 20 years old, they've looked at the numbers. They're now making subjective decisions, and it basically comes down to two things in their due diligence they're trying to learn about you that has to do with investment process. One, what are your investment beliefs? How do you see the world, and what's the sandbox that you play in? And how do you assemble and manage a basket of holdings? Because if you make it through into semifinals and you are being discussed at the investment committee level, nobody's dickering over who has a better R-squared or Sortino. It's whose process do we subjectively believe, we who don't do this for a living every day,
Right.
is the most sensible, repeatable, and defensible way of doing name your thing. The problem is everything I named is beyond the numbers, and it is text-based, beyond oral.
So
It doesn't fit in a flip chart.
What tips do you have for managers or manager wannabes when it comes to identifying or targeting appropriate investors?
Well, first you have to know what you are telling and selling, which is why before you even go to legal to be able to give them content to say here's what goes in the OM, you have to answer the question that Jack raised. And the way that I put it is, the starting point isn't let's make a pitch book because everybody has one. Assume you're granted a round one in-person meeting. You have 60 minutes, maybe 90 minutes. Jack's already seen your data, reverse engineer what you do with the time. And you want to come in and say, thanks for granting me the time. I want to explain my thinking and my process and what's behind it. And then maybe I'll show some holdings and demonstrate they have the characteristics I just talked through. Ergo, no strategy drift. But when you're ready to leave the meeting, the problem is over and above a pitch book, even if it's time to make one, Jack's a really good guy. He doesn't have good detailed long-term memory. And too many people forget what they learned in kindergarten when the teacher or at a birthday party somebody's parent taught you how to play the telephone game. When the last kid says out loud what she heard, and then the birthday boy said what he really said, everybody giggled. Imagine you're trying to get an evangelist at an investment committee. How do you reduce the odds of them screwing up retelling your story when you're not there? If you end up building what to do with that round one in-person meeting and also have it in print. So not only can you tell it verbally to Jack, you could pull out of your briefcase and plop down a document and say, over and above the data, here's a refresher about how we invest for your investment committee. I've now let you in on a secret on how we've helped clients outmarket competitors and attract over $7 billion. Do that part at the beginning, because you, the PM, have to be able to tell and sell it before you can even hire an in-house salesperson or third-party marketer and then teach them. Because those people don't tend to know portfolio management. You are gonna have to teach them.
Right, okay. And let me pivot to you, Ed.
Mhm.
You have been at this for decades, okay? Raising money in any environment is gonna be challenging. What approaches have you had success with before when it comes to working either with third-party marketers, cap intro teams of the prime brokers? What has your experience been?
You have to know the audience you're going after, okay? And what I mean by that is, say you're a wealth manager and you're deciding to launch a hedge fund, as an example. Well, you're not going to have much success with a foundation or endowment because that's not your client base, right? So you're wasting your time. But you've managed the money for a bunch of individuals or families or, you know, high net worth, whatever the case may be. Well, you should identify those people that you think this message would resonate, because you're already managing their money, and you have to explain to them why you're doing this and would they be interested in investing. You know, too many people are going down avenues they don't belong in.
So, I'll
That's
give you an
one
example.
reason.
What about international investors? What about fund of funds?
I historically have always stayed away from international investors because, one, they're a pain in the ass. Two, it's difficult, and at the first sign of any type of portfolio headwinds, they're abandoning ship. So we stay away from them.
Jack, I saw you reacted to that. Any
No, it just reminds me of when way back when I was running a hedge fund. We had U.S. funds, and then some capital raiser out of Europe found us and sold us this wonderful story. I can raise a lot of money for you, and he did, and it lasted about 12 seconds.
There you go.
We created a whole offshore fund, special, with a special fee structure, so he could get his piece and whatever. And then, literally, it as fast as it came in,
it was
went.
gone.
So
Yeah.
yeah, I mean, I again, sort of just following up on what Eddie said. You really do need to know your audience. I will say we've had now over the past 7-8 years a great deal of experience raising capital or introducing capital from foreign investors to our clients in the U.S. Part of it is having boots on the ground,
Mhm.
in different
Yes.
parts of the world, and having people in the organization who understand what those clients are looking for. So, I mean, I think depending on the strategy, depending on the goals, and quite frankly, the flexibility of the manager to accept capital in different structures. A lot of the European investors like SMAs. You have to want to take them. If you don't, you're not going to get the money. So those are all kinds of things that I think you need to think about when you're going to try to raise money from groups of investors that are different than sort of the
Sure.
main ones you focus
So
on.
Jack, at this point in time, we have startups in the audience. How does the capital raising environment look for startups right now?
It's tough. It looks like a barbell. The guys or gals spinning out of Balyasny, Millennium, Citadel. They go out and they have name recognition, and they're getting $250 million, $500 million, $1 billion, like it's nothing.
Right.
And then there's the smaller startups who are scratching and clawing to collect small amounts of money, and the middle is like there is no middle. It's very difficult. So we keep hearing and reading about all this money that's being raised in hedge funds, and the amounts themselves are large, but it's very, very weighted toward a small number of very large startups.
What about first loss?
I mean, first loss is an interesting way to get going, but you're putting your own capital on the line as well. What we found is that some of the first loss structures have become more flexible and are willing to commit capital to commingled funds.
Sure.
So there are opportunities to do that, but again, that's a very different animal. It's does it fit with the strategy that you're going to be engaged in? If you're highly volatile and you have large drawdowns and large gains, first loss might be scary because your capital goes first and they can pull it at any time.
And you need an exit strategy.
Well, that too.
Yes. And so I'm gonna come back to Bruce and to Ed, and I'm gonna ask you guys to comment on what red flags are you aware of that would automatically disqualify a manager in front of an investor? What are some things that managers need to be aware of there in terms of red flags? What eliminates new managers from serious consideration? Eddie, what do you think?
What's interesting is the investor community could give you any one of 1,000 reasons they're not gonna allocate to you. That's the problem. You could do everything right, okay? It makes sense for their portfolio allocation, and you still get DK'd. So it's a very, very tough environment, no matter how good it is. Now, family offices have always been, I've always viewed them as the lifeblood to the emerging or the
Startup, small emerging.
startup and middle markets group,
Yeah.
right? As Jack correctly said, people that are coming out of the well-known names, assuming they have a pedigree, sometimes that's not the case, because I know of a number of firms that launched, had the capital, and imploded,
Sure.
because they didn't know how to run a business, okay? So that's a slippery slope. But the family offices have always been, to me, the best allocator of capital to startups and middle markets managers. So,
Because
10 million, because they like them, they can touch them, they can feel them. It's much more personal. When you're dealing with an institution, you're going through the factory, the robotizing review.
And would you say that the institutional investors are a little more, let's say, analytic in their approach?
It depends.
Okay.
It depends. I mean, everybody thinks an institutional investor is smart. The fact of the matter is they're not. You have a lot of institutions that are not astute. These institutions have a tremendous amount of turnover. So you could be right at the gate of getting an allocation, and the portfolio manager's no longer there. Guess what? You're not getting it, and you got to start over, right? I'll never forget this, and this is a good point. I went in with a family office that I worked with. We were going to select this manager who checked all the boxes, was excellent. We did the due diligence. We go into his office for the closing meeting, and within 5 minutes, I knew the investor wasn't going to allocate to them. Guess why?
Why?
He had a model of a private plane on his credenza behind his desk. I will never give money to a manager that wants a private plane. True story. Yeah, I have seen people get dismissed immediately because the numbers in their deck.
So what you're asking is, where are the customer yachts?
Yeah, the number in their deck or the font on their deck had a different color or the numbers were off. Done.
This is a good example
Okay.
of if you make a mistake that my 5th grader wouldn't make in
There you go.
elementary school using Word or PowerPoint, how can I trust you with detail in running a portfolio?
And that happens a lot.
Okay.
But with the family offices, we haven't seen as much allocation because they've done so much private investing. They're not just having the liquidity events with those investments where they have capital available. I mean, I know billion-dollar families that are basically borrowing money to pay their tax bill because they don't have the liquidity.
Mhm.
So I think that's been difficult for the smaller and middle markets guys, $500 million or below.
What we are starting to hear from endowments and foundations is exactly that part of the story. They all went into private equity, private
Yes.
debt. There's been no liquidity.
There's no
events.
liquidity, right.
Right, so as they have new capital coming in, they're allocating to liquid strategies. So we were at a conference not too long ago, and there's 3 endowments speaking, and every one of them said, we're looking for long-short equity managers. I hadn't heard that in a while.
In a while.
And it's not because that's, they're like clamoring for it. We need that because our portfolio is way overweight in
Right.
illiquids.
Illiquids. Chris?
Yeah, another big red flag, somewhat related but not entirely related, especially when you talk about the Balyasny, the Millennium, the Citadels, is do you have approval from your prior employer? I can't tell you how many times I've had managers who are raising funds and they learn after they've pulled capital that they're in violation of the restricted covenants of their employment agreement, and they now have to cool off for 6 months or 12 months. Or it turns out you don't actually own the IP when the allocators or the managers are going to do due diligence on you. It's actually the trading algorithms or the IP are actually owned by your prior employer. So a common red flag that I talk to new and emerging managers, they haven't told anyone, they haven't told their manager, they don't even realize they're on a Millennium 24-month non-compete. When they talk to me first, what's the relationship with your current employer? What's the relationship with their current team? Who's spinning out? Do they have lawyers? So very, very common red flag first. The last thing you want is to raise capital, have a close, and then find out you're being sued by your prior employer to enforce the non-competes.
Excellent point.
So,
Yeah, that-
think about that, right? What we've been, you're a proprietor now. What level of comfort is anybody gonna have when you don't know your own employment agreement? I mean, really? So, you have to be simple smart. In order to be simple smart, you have to know what you're doing. That's the trick.
So there's a related element to that which answers your red flag question. We found that since 2008, with that crash, there was a second set of incidents where family offices were hit, where there were losses, and money managers said, sorry, can't hit my high water mark,
Right.
we're shutting down. But it didn't first happen then. The mid to late 90s build up with the bubble there. A lot of investors were going in buying on pedigree. Did they have an idea what the hell the manager was doing? No. So when you hear Jack saying, factually so, that there are these shops that are starting with this much money, do you know how much due diligence is really being done on them?
Right.
So what we find for the small manager was, and when the tech bubble burst, the family members who weren't on the investment committee said, what happened? And the answer was, I don't know, I picked people that had good pedigrees and they had good track records, just an unexpected thing occurred with the bubble bursting. A finger was wagged, don't let it happen again. I now have told you 2001. We get to 08, it happens again. What we found from then on forward is not only do they want somebody that has an okay track record and can explain methodology, does she or he have a small business owner's head on their shoulders? They're worried as much about business risk. So we're counseling startups. When you go in and you're sitting down, 80% of your time you want to talk about your strategy. You want 20% of the you tell time to say, let me tell you about the business plan. I've already thought, when we end up hitting this in AUM, here's how I'm reinvesting in the business. When we hit this, I'm doing that. It's the people who don't do that, or who say, oh, I'm not spending any money on marketing now. I'm waiting until I get in 3 more of you, Bobs, then I'll do something. That scares the shit out of people, and they won't allocate.
All right, gents, we're having a good time with this, but we're running a little behind. I'm sorry, Rob.
So can I just add to Chris's point about not realising they have a non-compete? Is we speak to a few, we see managers who left a big shop and they haven't properly negotiated their exit, and they think they're going to get 100 cents on the dollar for what's coming their way, and a lot of the time they don't get that, and then they end up in a protracted legal and fight with their former employee. So they've assumed, okay, I'm going to launch with let's say 10 million, of which 5 of that's coming from my previous place, and then suddenly that 5 isn't there, and it just slows everything down.
It has a cascading effect throughout
absolutely.
the whole process.
So it's not just about knowing your non-compete;
Yes.
it's actually knowing, how much money that I think I'm going to get,
am I actually going to get?
Thank you.
Yeah.
Chris, let me swing back to you, all right? What should fund managers know about negotiating seed and anchor investments?
Yeah, so there are a couple of variations that they typically take. Often what I'm seeing is what's called GP-LP seeding arrangements or anchoring arrangements, where you're effectively being given a working capital facility to launch your business. That could be X million over 2 or 3 years. It's basically a credit agreement that's collateralized by the fee revenue streams. So you'll have an anchor agreement that will memorialize all of that, and then oftentimes the provider of that is going to be in your GP entity getting a piece of the carried interest or the incentive allocation. And they're also going to get a piece of, generally top line is what I'm seeing, which means they take their cut of the management fee before everything else. So you're seeing top line on the management fee side. So oftentimes in the anchor agreements, some of the more finer points that we're negotiating are, of course, economics. So all of the economics, what level. We're seeing a lot of negotiation around the ability to buy out. When can you buy out? On the flip side, we're seeing a lot of negotiation on a put for the provider, right? If you're bottom quartile 2 years running, they want an ability to put that back and get out. So oftentimes on anchoring agreements, first-time fund managers, those are generally high-level themes. And then, of course, everything we just discussed already, those are all going to be points that the anchor is going to provide, or at least the seeder is going to provide. So there are different variations of that, but they typically follow those core themes. I do think you're seeing more and more, and you're going to see even more RIA M&A, where you're seeing large institutions. I think very analogous to the Blackstone Citrin transaction, right? A lot of big sponsors that have capital are now looking at this industry as a fee-generating industry, and so they're now taking stakes in managers as a business, as they are looking at it just like any other advisory business. So those are common themes that we're seeing, but from an anchor negotiating standpoint, those tend to be the more common themes.
Thank you, Chris. Thank you. James, how does due diligence impact fund formation and fundraising
Yeah,
from
I
an
mean,
accounting standpoint?
From an accounting standpoint, due diligence, you've got to know, as the others were saying, you have to know who your target audience is. And depending on who your target audience is, that's how you need to prepare for the due diligence. Is somebody going to come on site? Is it going to be a day-long visit? Is it just going to be a standard due diligence questionnaire that you need to kind of fill out and get back? You need to understand that. But they're all going to look for similar type things. They want to understand how you're going to handle legal and regulatory compliance, cyber. They want to look at your operational infrastructure, risk management, who your service providers are. From an accounting standpoint, you look at that operational infrastructure, and they want to see how you're going to handle your trade processing and your middle office, but they want to see your back office accounting as well. You've got your fund administrators taking care of your official books and records, but who at your firm is going to then oversee that fund administrator? Do you have enough capital that you can go out and hire a high-level controller, a high-level CFO, or do you want to go to a shop that will handle outsourced accounting for you, outsourced CFO? So I think that's important to think about those things from an accounting and back office standpoint when you look at due diligence.
Okay. Eddie, let's pivot for a second. Let's talk about some of the business issues. People.
Mhm.
Okay, it's often said in a service business, the most important assets a firm has go up and down the elevator every day. Okay. How have you approached hiring? You put a lot of emphasis earlier on CFO, COO.
Mhm.
So how do you approach that?
Well, you don't want to overhire. You want your platform to do as much as possible so you can avoid that, okay, as I alluded to earlier. And you want to hire a good athlete that can do a lot of things. And I'll be more specific. Historically, and even to date, when you deal with a startup manager, it's, I need to hire my lawyer and I need to hire a CFO. I understand the lawyer, because that's very important. Formation's critical, more time, you got to go back and forth as we discussed. After many years, I think you want to hire a COO versus a CFO, and here's why. A CFO is most likely coming from the accounting world, which is fine, okay? They're more of a controller as opposed to a CFO. Many people that work at an audit firm and do audits for hedge funds, they think they could be a CFO. They can't. No differently than, and I'm saying this with all due respect, somebody in prime brokerage relationship management and service saying, oh, I could be a COO at a fund. The fact is you can't, okay? You may know things about it, but you can't. A chief operating officer is going to bring a different skill set that's much more diversified than a CFO. And that's what you need in a startup situation. In addition to that, getting back to our service partners, you have more than enough CFOs or CPAs, at your audit firm and at your administrator. An experienced COO will know a balance sheet, will know credit and debit, and it's their responsibility to stir the drink with the service providers or service partners. That's the role. So you need somebody that can return punts, line up in the backfield, maybe go to tight ends, special teams. A COO brings that to the table where most CFOs don't. Furthermore, if you want to negotiate an ISDA, or you have to do enhanced leverage, or you have to do different types of things, most CFOs don't know how to do it, and with no disrespect, they go to the accountants. A good COO knows how to do that, and they go with the law firms. A good COO works with the law firm to get you in a good place, because the master agreements aren't negotiable. It's the credit support annex and things of that nature. And you need to know how to navigate, because 1, it reduces cost, 2, you multitask, and 3, it doesn't burn your run rate by throwing a lot of bodies at it.
Jack, what are your thoughts on service partners, service providers, and personnel?
Well, I was gonna say on personnel, start there for a moment. If you're starting with a partner or partners, to Chris's point earlier, you need to have that documented really well. And the part that really needs to be documented well is what happens if? What happens if one leaves? What happens if one dies? The last thing you want to end up with is, having that person's spouse be your new partner. It can't happen. It ruins your firm. So you end up having to document all of this and prepare for it. It's sometimes uncomfortable to think about it, but you need to know what the exit is and how you provide for it, and whether you end up having to get life insurance on each other's lives, with the other one's spouses or estates as the beneficiaries. Those are really important things to consider if you're starting in a partnership with more than one person.
I just had that conversation.
Yeah,
The
that's-
exact conversation in the agreement.
That's an incredibly important point. You don't hire family members, and you don't hire your golf buddy or your college roommate. You don't do it.
Okay. Gentlemen, I hate to say it, but I think our time has come to an end, and I'm going to ask you to make quick, brief closing statements. I'll begin with you, Chris.
Yeah, sure. I think proper planning prevents piss poor performance, as we used to say in the Marines, right? Plan ahead, and it always takes twice as long, and the comments about you raise half as much as you think, all of those things are true. It doesn't mean it can't be done, but you just need to come at it from a different point of view or different perspective based on the advice that was given today.
Yeah, I would say think long and hard, and then think long and hard again about whether you want to do this or not. It's, you're making a big decision, and you should spend the proper amount of time researching, the opportunities and the challenges that you're going to be facing. Know what you're getting yourself into.
There's nothing wrong with saying, I looked into this, and you know what, I'm more comfortable being an employee.
Correct.
Working with a bigger firm. This really isn't for me. Because you have to go into this assuming, as you've heard, for 3 years, you're probably gonna make nothing, and you're spending down your savings. Do you have enough of a savings war chest? And is your family going to allow you to do this without stress and going, it's been 1 year, and it's not, because it could take at least 3 years until you start to get the first investor of semi-decent size to show you that there's a light at the end of the tunnel.
Eddie?
You're doing it for a reason, and one of the reasons is you want to control your own destiny. So control your own destiny, put the work in, put the effort in, do the evaluation, and make the best decision for you. After doing the whiteboard, for example, as the point was just made, if it's not for you, stay an employee. But if you're going to do it, You have to do it for 3 years, because you're not, you have to be able to pay your bills and pay the people that come to the firm. Your people come first, not you.
Rob?
Okay, from what I've seen, so raising capital is by far the hardest thing, and no one cares about the fund as much as you. You are the only person whose first thought in the morning is the fund, whose last thought in the evening is the fund. So you have to own it. And then lastly, I'd say is, if you can't articulate what your edge is, that means you haven't got one, which means don't start the fund.
James?
Yeah.
Thank you,
I
Rob.
think I agree with what everybody said here. The other thing I'll say is, lean on your service providers. They are the ones that have the expertise in running the business. Right? You're the trader, you're the one that knows how to make money with investing. Lean on your lawyers, your accountants, and everybody else to kind of help you to run the business and take care of all the things that you weren't taking care of when you were an employer who was just responsible for trading.